Good day, everyone. Welcome to the fifth webinar in our EdWeb 2020 series. You're more than welcome. We have attendees from all across the MENA region and beyond. Today, we're going to discuss the title Dollars and Cents, Financing Options for Education Providers in the New World Order. I love the title. I also look forward to the conversation. We have a great panel who I'm going to introduce you to now. Firstly, Gemma, can you introduce yourself, please?
Thanks, Ivor, and thanks for inviting me today. Very much look forward to our conversation. So my name is Gemma Wild. I'm the sector head for education across HSBC for the Middle East, Northern Africa and Turkey. So education is vitally important, for our region globally, and HSBC supports the education sector right across the world. And that really is about the whole ecosystem. So the student, the parent, the operator and the investor. And our passion is much wider than financial services, actually, because we invest in the future skills and financial capability programs through our sustainability agenda. So thanks again for inviting me and look forward to the conversation.
Pleasure to have you. AJ, over to you. I think AJ has frozen. We'll come back to AJ. Mamoon.
Hi, thank you, Ivor, for inviting me. I'm a finance partner at Ultimimi & Company. I've been with the firm of just over 15 years. I'm also part of the education group in the firm. My specialisms are corporate lending, trade finance, and structured finance. I've been involved in numerous financing arrangements for either startup education institutions or established ones for the continued operations. I'll be hopefully discussing a few issues from a security and collateral angle, supporting the esteemed panel that we have here today. Thank you.
Thank you, Mamoon. And our third panelist is AJ Kathuria, who from EY Parthenon Education team. But there's some technical difficulties at the moment, so hopefully AJ will be able to join us. It's not as embarrassing as last week, where our webinar was about tech issues and we had a major tech meltdown. But let's see, AJ, are you back with us? He's not. Okay, but look, you are. AJ, can you hear us?
I can hear you guys.
Great. Would you like to introduce yourself?
Thankfully, this one is not about. Thankfully, this one is not about ed tech. So we're good.
AJ, would you like to introduce yourself to our audience?
Sure, absolutely. Thanks, Ivor. First of all, thank you guys for letting me be a part of this webinar. I think it's a great title. I think so as well. A lot of you might already have been in touch with EY Parthenon. We're the largest education-focused consulting firm in the world. We have close to 100 education experts working globally. I'm a director with EY Parthenon. I have over 45 engagements worth of experience in education over the last 5 years. EY Parthenon does close to 300 education-focused projects globally, and my focus is largely the MENA region, specifically the private K-12 and higher education sector in the MENA, the MENA region. Happy to be here. Look forward to a great conversation.
Great to have you, AJ. And clear from all the descriptions, we have a stellar panel packed with experience and also commercial know-how. So, look, Gemma, can I ask you the first question? Without further ado, let's just get straight into it, and let's not beat around the bush, because what we're all hearing is stories of an absolute bloodbath in the education sector from a cash flow point of view and a financing point of view. And I would like to hear from HSBC's point of view, with your tentacles spread wide and far across the region. What are you hearing, and what's your take on what's happening at the moment?
Yeah, thanks, Ivor. So I thought it was probably worth just giving you a sense of what our clients, both regionally and globally, are saying, both in the education sector, but also what we're seeing across the piece, because I think there's similarities there. So part of my role since this all sort of kicked off was actually, in addition to the education sector head, has actually been reviewing some of the capital and interest reprieve requests on loans across all sectors. And really the modus operandi is very much about handling the current situation very much day to day at the moment. It's about balance sheet preservation, and it's about sustainability and survival. And so in terms of talking about the education clients specifically, there's really 4 key trends, I would say, that we're talking about all of the time. And the first is collections, so that applies to term 3 collections, and also will be a feature going forward. The second is cost control. The third, future enrolments, and that's 2020 and going forward 2021. And then what will the teaching operating model be as of September? And dare I say, the new norm, what does that look like? So if I touch on each of those briefly, so fee collections, you know, the successful collection of term 3 fees is actually quite different across entities. So some are saying to me that collections in term 3 have been much better than expected. So up to 97% I was quoted yesterday, which is quite staggering. And some as low as 50 or 60%. And such disparity does seem a bit surprising. However, we do know that those parents who have felt truly engaged throughout this process have been most inclined to pay their fees. In terms of cost reduction, so you know, everyone will know that overall schools and higher ed have been looking at all of their costs, whether that be fixed or variable. That includes rent, utilities, etc. Rental reprieves have started to come through. Many schools are trying to avoid teacher cuts, but as we know, this is sadly happening in lots of areas. And of course, institutions are coming to us, the banks, for postponement and deferral of loan repayments, and we can go into a bit more detail about how that's been happening a bit later. And then September enrolments. So as we know, again, there's very, very little visibility around this. But personally, I don't think it's really as straightforward to predict that one price segment will be more affected than the most. I think it's much more complex than that. It is safe to say, though, I think that we'll all be in agreement that there will be some winners and there will be some losers as a result of this crisis. And those schools with a strong track record that have been well engaged in their communities, you know, importantly, the perception over value for money has come up a lot. So that's pre and post crisis, I think, will be the winners. And in higher ed, actually, some universities are seeing strong applicant numbers. Bear with me, technical. Here we go. So for higher ed, some universities are seeing strong applicant numbers. And I do think actually that we could see an increase of GCC students staying in the region to study versus perhaps those that might have been going abroad. So in fact, you know, some international branch campuses I was speaking to only last week have seen an increase in inquiries. So that said, you know, those heavily reliant on postgrad students, I think they'll be more affected given the fact that a lot of those are self-funded and some have lost their jobs. So the million-dollar question still remains. It's how many expats will leave and what does this mean to student numbers right across the education piece, and therefore how big is the pie at the end of this. So back to you.
Thanks, Gemma. A lot of food for thought, and we'll revisit some of those themes. AJ, EY Parthenon, what are you seeing and what are you hearing through your telegraph throughout the region and globally, but particularly in this region, across all 3 parts of education, you know, nursery, K-12, higher ed, but please focus on any one of those that you wish.
The answer is sort of divided up into markets which are more expat focused and less expat focused, right? When you talk about it's a lot more expat. The markets that we're seeing, which will probably see a higher impact in our view, and that's what, when we speak to operators, investors, and even parents, that's what we see as being a less resilient market than say a KSA or an Oman or a Kuwait, which are more reliant on locals. I think I echo what when we I think the nursery segment is probably the most concerned about safety and security. And
AJ, can I ask you? We're having some problems. It's a bit garbled. Would you mind leaving and coming back into the webinar just so we can iron out that issue, because we're not catching everything you're saying?
Sure.
Thank you. And we'll come back to AJ when he comes back. But I was going to ask Mamoon then, in relation to the options available. I mean, Mamoon, you advise a lot of education providers, a lot of banks as well. So you're ideal in that you're on both sides of the fence. What options are there from a financing point of view for education providers to survive and indeed thrive coming out of this cash crunch?
Sure. I probably have to divide the response in two parts. One is something we can perhaps cover later in the webinar. Is the stimulus packages that at the moment are available in the market. For the UAE, of course, and I'm only talking in relation to bank debt. The central bank has come out with the targeted economic support scheme, which has its own very specific guidelines, which provides banks and financial institutions licensed by the central bank of the UAE with a stimulus package, which then can be translated into a certain relief to existing borrowers, including education institutions, which are borrowers of such banks. They are largely based on a zero-rated facility, which is in the amount of 50 billion dirhams, which has been offered to the banks. And as of last week, we understand it's been fully utilized by the banks. So most of the 27 banks in the UAE have utilized that facility and then can provide a certain form of stimulus and relief to their borrowers. It has also provides a certain capital buffers to be reduced, which allows the unusable capital to be deployed in relation to any distressed borrowers. It also further encourages, these guidelines encourage banks to support, particularly on the working capital side, for these SME or mid-market borrowers, particularly educational institutions, to continue their operations and utilize such facilities. And most importantly, it actually offers any particular bank that has utilized the zero-rated facility would need to work within the parameters of the guideline and offer deferral of payment of principal as well as interest up to a period of 6 months. Now, what we understand from banks, some banks are providing, looking at a space of between 3 to 6 months. Some banks are looking at on a monthly basis. So it's how you engage with your financial institution, providing them, be very transparent, providing them all the details and a projected plans in the next 6 months to avail such a stimulus package. Over and above, I think there are other packages also available. We do understand that Abu Dhabi Fund for Development have also provided a stimulus package. It does not specifically mention educational institutions. It's largely for healthcare and for industries, but they do mention any industries which are disrupted by the COVID-19 pandemic can also utilize it. Their threshold is a little higher. The revenues should be around, in the last 3 years, should be around 150 million, and their asset valuation should be approximately 10 million dirhams. And they need to really put in place certain projected plans in order to avail these facilities. So these are the stimulus packages that are currently available, which can be availed by educational institutions. Now I come to the second part, which is now that you perhaps have either existing projects that need to be funded, which began prior to COVID-19, and you're engaging with banks and financial institutions, and you're looking at what kind of security or collateral you can provide them. Banks, of course, it's very important to note that, and I would like to emphasize this point, is that banks would need a certain security coverage in order for them to get approvals for any new funding, and particularly more so in what's going on at the moment, where some of the education institutions may be in a certain distress. So I think the primary security the banks would like, which is sometimes difficult for education institutions, is security over hard assets, land security. As we know, most of the education institutions are either I think it's seldom that they are constructed on land owned by the operator of the school or the owner of the school. Particularly for foreign education institutions operating here, they're mostly on leased land. So there is now room to explore the option of converting the leasehold interest into more of a bankable interest. You have options working with the local land registry and your local sponsor, as well as the local lessor, to convert your land into a registered or a usufruct title, which can then be mortgaged in favor of a financial institution. And that really enhances the security coverage for a bank which is willing to lend. The secondary security, of course, is the cash flow and income. That's essentially divided based on the market here, divided between fees of collection, as Gemma had alluded to earlier, paid through credit cards, which is a common factor here, or paid through post-dated checks. So this is where perhaps educational institutions can engage and either escrow or route through these income through the lending bank with certain level of security over it. We've got a new secure transactions law, which is almost 2 years old now, and it now provides much more flexibility in terms of withdrawals from such bank accounts, floating security over such income receivables, which again, as I mentioned earlier, would enhance security coverage. Then we come to share security. This is what was common, what is now common, but was not common before, because most of the educational institutions operated on the basis of a limited liability company, particularly the high schools and the lower education centers. That's where the share security for such LLC companies only came 2 years ago, but it's becoming now popular. So a security over the stakeholder interest is now possible and can be registered with the Economic Development Department. And from my understanding, it does not require a KHDA approval to provide such security. So that's something should be explored. Now, this is where another complexity comes in, particularly for foreign educational institutions which work with a silent partner, which is the 51%, who may not have a understanding of providing security and may take it a more personal issue in terms of providing security over its stakeholder interest in the LLC company. So there is an education exercise required at that stage that security is only restricted to the shares, and the silent partner does not contribute any capital. So it does not translate into any security over the silent partner's personal assets. We had to work around with quite a few of UAE local national partners, such educational institutions, and to get them educated and then to provide such security. We've also been exploring security over, well, it's very common to take security over debt reserve accounts, particularly for large term loans availed by educational institutions, which is quite a common security provided. But I think in this market, perhaps the borrowers, educational borrowers can also look at providing security over collection or revenue accounts, where these checks are deposited into, or where these credit card receivables are assigned into. Perhaps those collection accounts can also be secured in favor of the lender to enhance the security coverage. I'd like to at this stage also make a distinction between borrowers that education institutions that avail working capital facilities which are less secured and they're not covenant heavy. They're mostly for their routine operational expenses, and large term loans which is for their capital expenditure, construction, or enhancement of the educational institutions. So that's also something to weigh. Perhaps at this stage, in the next couple of 6 months, the educational institutions may need more funding for operational expenses as opposed to any capital expenditure. So that's where capital expenditure can be cut down, and there should be a more focus on securing operational expenses. Again, we have explored some aspects of in larger borrowings for stipend rights. It's more contractual, not judicially tested, where perhaps a bank can potentially come in and change the manager. Again, it does require a KST approval, so not a very popular security at this stage, but that's something that borrowers and banks can sort of work together to put in place. I think a very important point, that's something we've been discussing in the panel before, is corporate governance, which is intrinsically linked to providing security, particularly for nurseries. I think what we've seen in certain sort of segments, nurseries still operate through sole establishments, where the UAE national owner effectively is the owner of the nursery, and it's operated through powers of attorney. And we have seen on numerous occasions that the power of attorney does not have enough powers to create security, and then there's actually a deadlock. Again, a lack of understanding on the part of the owner and a dispute between the owner and the operator. So that's something is extremely important. Banks would like to see very clear-cut corporate governance. All the powers have been granted, whether it's a limited liability company structure, a free zone structure, or a sole establishment arrangement. A clear causal link between the powers from the owner to the operator in terms of operating and creating security. So I think these are the main points I just wanted to highlight from this perspective. Yeah.
Thanks, Mamoon. That's really thorough. I would like to come to Gemma about some of those from the bank's perspective, but before I do so, I would like AJ didn't get to finish his piece. So AJ, shall we try again and see how we're doing? We lost you.
Let's give it another. Yeah, let's give it another go. Let's see how it goes this time.
Thank you.
I don't know where you guys lost me, but what I was saying was that the answer sort of depends on whether it's a expat heavy market or more local heavy market.
We got that.
What UAE, given its higher reliance on expats, is a more vibrant market, allows for higher price point. But what also happens in downturns is it makes it less resilient than maybe a KSA or an Oman or a Kuwait, which are more local heavy when it comes to both higher education and K-12. What we're seeing, though, I think I don't want to repeat some of the stuff that Gemma already spoke about. There is volume pressure. There was volume pressure even before the pandemic on both higher education and K-12. There had been a slowdown in both those markets 2 to 3 years prior to the pandemic itself. But we are seeing some green shoots come up as well. There will be a flight to quality, as we like to call it, what sort of Gemma also touched upon. K-12 school, K-12 operators which have showcased high quality education, which are high on ratings, which do offer value for money, are probably going to see perceived value for money, are probably going to see parents flocking to them. With respect to higher education, what we're seeing globally is that, as is the case with Dubai as well, it's a regional hub for expats coming in from some of the GCC countries in South Asia as well. And there is an opportunity there for a lot of higher education providers to probably solidify that position as a regional hub. There is going to be a lot of anxiety when it comes to parents sending their children abroad for higher education to the US, UK, which have a higher number of cases, which have a higher incidence rate. And in these times when a lot of institutes are planning to start their September term with part online or hybrid or fully online education, nobody wants to pay full price for that, and that might make for sort of a good sort of killing for Dubai, especially and maybe some other countries around the GCC, which have a vibrant sort of higher education market, to tap into that by showcasing affordable education, quality education, and the kind of providers which are already present. So that's something that I would take as a positive as well, at least from the higher education side.
Thank you, AJ, and great to hear positive. We're not hearing enough of them, so this is good. Gemma, back to you. Mamoon covered a lot of the issues in relation to, I suppose, what we would be advising our clients that banks would be looking for as regards security. It'd be great to hear your views on it, and just generally what options are there for education providers to access finance. And also maybe an idea of, from listening to Mamoon's list there, my impression is that could take a bit of time to put some of those things in place. Some of them quicker than others. Obviously, the real estate thing might take quite a while to put that in place. So maybe just an idea about that as well, if you're happy to do that.
Yeah, absolutely. Thanks, Ivor. So, I mean, in terms of this crisis, banks tend to be the obvious one in terms of that sort of financial support, whether that be short term or more medium, longer term. What I would say around that is, being honest, it's difficult in this times to expect new lenders to step in at this point, where you don't have a relationship, you don't have the track record. So now it's really the time to look to your existing banking relationships, those whom you've rewarded hitherto, and ask them to support and help work through these uncertain times with you. So in terms of how to do that, what I've seen really work really well thus far is those clients where we're engaging very early, keep the dialogue regular, and I think because things have changed, you really need to keep your forecasting. Your forecasting needs to be dynamic too. And whilst we appreciate that it's very, very difficult to predict where we're going to be going forward, If you do need to call upon your bank for loan reprieves or even additional funding, it makes sense to have looked at your base case. So making some really educated assumptions around your likely revenues and your likely enrolments, given what you understand about your individual assets. So you may think I'm completely barking mad by saying, you know, look at your forecast, how many enrolments are you going to have? But actually, in this uncertain environment, there are sort of things which you can look to do to make a credible story in terms of that conversation when you're speaking to a bank, because you're having ongoing dialogue with your parents or your students, perhaps in higher ed, in terms of what they're thinking of doing. You're getting their ongoing feedback. And also you'll be able to look at your previous trends in terms of enrolments, the dynamics of the population that surround your location, your price point, your usual attrition trends, whether you've previously had wait lists at certain year groups, and therefore you could be quite comfortable that you might get, as AJ was saying, that flight to quality. So therefore it's a great starting point if you're going to have that conversation with the bank asking for their support, is actually we've worked through all of these assumptions, and whilst we fully recognise that any forecast is pretty much going to be wrong from the day you actually put it together, actually it gives you a starting point to plan for eventualities, and it's hopefully given you a downside risk scenario around cash flows and profits, which will help the conversation about whether you need a reprieve in capital repayments in the short term, or even do you need a restructure in the medium term. And I guess what it doesn't work to say is nothing's changed, our forecast remains the same, and therefore we can make no assumptions. So it's working together to actually talk about what those assumptions are. So, you know, it may be that you're looking to put a new facility in place to allow for some potentially ongoing tougher times with collections, which, you know, it could be quite likely. And so therefore, how much debt capacity do you have available to you? What's your affordability? Again, you know, we understand this is dynamic, and therefore sometimes we are working with our clients on several steps of this process. You know, the initial might be a concession request for a period of time on your existing facilities, on the capital for a few months. It may be then, as that's coming up, you know, nearer to the capital kicking in, that we'll have another conversation to say what's changed in your situation. So it just comes back to the point I was saying about that regular dialogue is so important. So, you know, another option in addition to the sort of standard bank lending, and this is only applicable to those sort of larger groups, but, you know, the capital markets is absolutely an option. Investors are really, really keen on education globally at the moment. We've just, for example, acted as a joint global coordinator and admin agent for Nord Anglia, who's raised 150 million on a new fund called Term Loan B, along with some other facilities, and they've done that to support their liquidity position. So outside the banking side, and I won't go into detail here because AJ will do that, but you've got the private equity houses that, again, interested in education, family offices, conglomerates. There's several clients of mine that I've been speaking to over the years that have been dying to get into education and have got deep pockets to do that. Sale and leaseback is an option, disposal of non-core assets. All of those have evaluation and control considerations, and again, I'm sure AJ will touch on that. And one final thing before I hand back to you, Ivor, is just around shareholder injection. I think this is an important one, and I know it's a contentious one, of course. You know, if shareholders have been receiving strong dividends over the years from, you know, an education sector which has been pretty robust in this market, yes. Just to echo AJ's point, it's slowed in recent years, and particularly the UAE in terms of supply-demand dynamics, but it's still seen growth over the last sort of 10 years. Therefore, you know, are the shareholders in a position to also support the business during these tougher times? And that's some conversations that, you know, you need to expect to be having with any lender. So that's it from me for now. Back over to you.
Thanks, Gemma. Just a quick follow-up one on the, you know, the education institution coming into the bank with unrealistic assumptions, or the old case, the old model rather than the new model as regards enrollment and everything else. Do you think that's an element of wishful thinking, or is it maybe an element of I need to put my best foot forward with the bank and then negotiate back? You know, like in a negotiation, I win with a higher set of figures, and they'll beat me down. Do you think? What's your view on that type of approach?
It's an interesting question, and I don't know if I've got a categoric answer to it. Maybe it is a case of saying, actually, you know, not wanting to really share the doomsday scenario. I think it probably is. So maybe, you know, and that's up to us as bankers to have that kind of honest conversation. Say, we understand that we are in these situations. We understand that actually things are looking different, and therefore don't be, you know, let's have an honest conversation, because ultimately, if we're all going into this basing our assumptions on the wrong ones, it's only going to be that in a couple of months' time we're going to have the conversation again. Because if we are talking about a restructure, let's say, then that restructure is not going to set them up for future. It's just going to be a temporary sticking plaster. And I think that's what we need to do. I think actually someone mentioned, might have been Mamoon earlier, about the monthly. Some banks are looking at monthly reprieves or 3 monthly. What we have been trying to do is look a little bit further forward than that, because actually the business does need to get on with the things that are important to it, and actually knowing that the cash flow is sorted is kind of quite important. And therefore we need to be looking at a little bit longer term where we can. Of course, as I said before, it's dynamic, but I think that the more certainty that we can give, the better.
Great, thank you. I just, before I go to AJ, just to say to our listeners that there's an ability to ask questions. I should have said this at the outset, but we'll take questions towards the end of the webinar. So if you have any questions, there's a panel on the platform that you can ask them. AJ, just picking up Gemma's point about M&A activity and groups coming in wanting to pick up distressed assets. What's your experience, and what are you hearing from your contacts? Cindy, why personal?
Absolutely. So I think, as Gemma mentioned earlier, the interest remains strong, right? Even pre-COVID, a lot of family offices, a lot of conglomerates present within the region and outside, a lot of private equity funds within the region and outside were interested in education. It's a more resilient sector than a lot of other sectors, especially in downturns like this. It's been a dividend paying sector. It's given high returns to a lot of providers who've taken the risk over the last few years. And there was a lot of solid interest that we were seeing even before the crisis, and that remains strong. We probably had at least the same number, if not more, calls coming in, inquiring about how the market is. You know, is it a good time? Is it a bad time? Things like that. And that's something which showcases education and its resilience when you compare it with other assets. I think one point to sort of mention here is valuations as well. And we've sort of had internal discussions. We've spoken to you guys as well separately. A lot of operators need to think long and hard about valuations now, ever more than than they have before, because in a downturn, a lot of these funds, a lot of these family offices, conglomerates will look to pick up assets which are quality assets, but are also willing to negotiate or have sort of downside protections in case of downturns. And that scenario planning, which Gemma spoke about, whether it's going to financial institutions or to private investors, is equally important, because you need to sort of have thought through how September is going to look like, and how probably the next year is going to look like at the bottom end and at the top end, not just the most optimistic scenarios. Private equity funds probably have record dry powder or capital available to them. They're always looking for bargain valuations. Each type of investor has their own sort of pros and cons, and that's something that operators need to evaluate as they decide who to sort of partner with. Sovereign wealth funds, for example, would probably have been known to offer more patient sort of capital and stick it out for longer periods, and that's something that could be explored as well. They've got a lot of funds on their hands and are looking for returns for their respective nations and nationalities, and that's something that could be another option for at least the larger groups to explore. But valuations are probably going to take a hit, at least for the next year or so, 2 years, maybe even slightly longer, till the market recovers. And that's something that, as I mentioned earlier, operators and current investors who are looking to bring in new investors need to have a long and hard think about.
Thank you. And just a quick follow-up, AJ, in relation to, obviously you said it yourself, sovereign wealth funds will probably be looking at the bigger groups, 100 million plus or even more than that. But private equity, what's their sort of floor, roughly speaking, for these type of deals as regards, would they be looking at a one-site operator, two-site, or what's their bottom line? Or they go in that sense?
Yeah, so I think it's the consulting answer. It depends. It depends on the scale and size of the private equity fund. There are smaller funds which probably will look to acquire single school assets or smaller platforms as well, and try and build on that. Maybe do some greenfield expansion in other GCC countries, maybe the KSA, Oman, and try and build a GCC wide or a MENA wide platform. There could be larger private equity funds who could do that as well. They would have higher ticket sizes, would look for established organizational structures, controls, corporate governance, and everything else already being put in place. But I don't think there is a floor. I think it depends on what stage they're at. If they already have a platform that they're trying to expand on, or are they trying to get into education for the first time, and those sort of variables, along with the fund size, ticket size, have a lot of sort of intermingling sort of aspects which play together for them to decide what scale and size of assets they should buy. I think one important point in especially the Middle East is there aren't a lot of scaled platforms or large platforms which are readily available to be acquired, right? I think apart from the regular sort of culprits, or the regular providers like GEMS, the next big providers are all are relatively smaller. So there will be a bit of work which is required for any private investor who comes in with a platform thesis, so to speak, with a thesis where they want to establish a platform and then maybe sell off the asset or sell off their stake in it. It's not going to be easy going for anyone, but I think if they stick it out, it's going to be they will be able to reap the rewards in the medium to long term.
Thanks, AJ. And you mentioned corporate governance, and I want to come to Mamoon on that because, some of these, particularly within the nursery sector, and also to some extent K-12 in Abu Dhabi, just due to the nature of the structure, there may be a UAE national on a license and a non-national who's effectively running it and bankrolling it. But that non-national may have nothing bankable or nothing that can be sold to anyone. Mamoon, can you talk a little bit about that and the type of structures you've seen being put in place to solve that conundrum, so to speak? We can't hear you, Mamoon. We've lost Mamoon. We'll come back, Mamoon, to you. Gemma, are you still with us?
I am.
Sorry, yeah. We'll come back to you on that if you can maybe log out, log back in, because we can't hear you. Sorry. In relation to a lot of the financing we're talking about here is sort of bankrolling and keeping the show on the road, so to speak. But some of our clients have said that they're now thinking of investing properly into edtech and software, rather than the band-aid approach of Zoom and Skype, and some of the smaller groups in particular haven't invested over the years, and are just getting through it, type of thing. Is that something a bank, without putting you on the spot as I put you on the spot, but is that something that a bank would look at differently perhaps to some of the other finance requests?
In short, no, it's exactly the same as any other investment that company would be making. And the assessment will be the same. It's about affordability and the business case for making that investment. And the business case is absolutely there, isn't it? We've seen the importance, and we've also seen those platforms or those schools which already had some form of provision in place and already had edtech being used in the classroom even, they were much in a better position to actually implement post-COVID and the lockdown, and therefore we've seen the importance of it. But also, you know, Ivor, you took part in our future of learning conversations about what's the new normal going to look like in terms of teaching. And I think the consensus was everyone in higher ed and in K-12 recognises that even if we're back in the classroom, which is the full expectation due to, you know, in terms of the announcement today of schools opening at the beginning of the academic year, there will be some form of blended learning, and also it's probably accelerated the need for that blended learning going forward. So the importance of the investment in that EdTech, I think, is well known, and therefore absolutely the bank would be supportive of such an investment.
Thank you. I'll try Mamoon again. Mamoon, can you hear us? Yeah, we can't hear you, Mamoon, I'm afraid. If you don't mind trying to log out and log back in. Yeah, thank you. AJ, just from your perspective in relation to EdTech, just briefly, I'm sorry to bring up EdTech, but it always comes up in conversations given the current environment. I mean, the old model was you build a 100 million dirham or even north of that school campus that had a planetarium and a 50-meter swimming pool and running track, and you know, there's equivalent to something out of the United States higher education scene. Do you think for new operators, not necessarily the UAE, but regionally, you know, the Saudis obviously opening up to foreign direct investment, do you think there's going to be a significant rethink about that particular model, given what's happening over the last few months?
I think there's going to be a rethink for sure. I think it's early days right now. There are so many numbers floating around. You know, when you speak to economists or you know, look at the newspaper articles, people aren't sure which segment is going to get the most impacted. But I guess the wider consensus view is that at least the premium segment is probably going to see some bit of hit as compared to the mid-priced or the more value segment, given the current crisis. I think there is going to be a rethink of the old adage, you know, build and they will come, and build bigger and larger and they'll come in larger numbers. It's probably technology interplay is going to become really important. We've been at EY Parthenon, we've been running a survey across emerging markets for K-12 students and parents, and taking their view on how the COVID COVID will impact learning going forward. And a majority of them say that technology is here to stay. 70% or upwards have said that even if schools open up, they do see hybrid learning or online as a supplement learning becoming important. I think that's where some of these schools will have to, the new schools which come up will have to think about investing in. I don't think the COVID crisis is gonna go away anytime soon. You know, at least I'm not an epidemiologist or an expert, but at least just from what I'm reading about it, it's not going to go away anytime soon. And I think that's going to change consumer behavior. It's going to, at least over the next few months or years, there's going to be an anxiety amongst parents. There's going to be social distancing, which is going to be in place. And whether it's schools opening to full capacity, there will be parents who want that flexibility for their children, for the you know, students who want that flexibility in higher education, maybe studying a couple of days, couple of hours remotely, and going to school a couple of days in the week. And I think technology and technology infrastructure is probably going to become a big differentiator for schools. Some of the other aspects will probably get scaled back. If you earlier you build two Olympic-sized swimming pools, you're probably going to think about one Olympic-sized swimming pool rather than building two. If you thought about building a planetarium or something else, you know, something just completely at the top end of the segment, you'll probably think about, you know, capital investments on that being scaled back and diverted towards technological infrastructure.
Thanks, AJ. And Mamoon, just checking, you're with us.
Can you hear me now?
Yeah, loud and clear. Lovely to hear your lovely tone there, Mamoon. The question was, and I think you heard the question, but just to go back to very briefly about the corporate governance structure that is sadly lacking, I think we can say, in a lot of cases, particularly nursery. Just some views on solutions for that high level.
Yes. As I was mentioning earlier, the most sophisticated educational institutions tend to use a management company to operate such educational institutions, which helps putting in place the necessary corporate governance documentation, either by way of powers of attorney or management agreements, and even specific amendments to the existing constitutional documents, which essentially provide quite comprehensive powers to the manager, which could be the 49% owner of the company as well. So that's quite helpful. Where we struggle is when there are sole establishments involved, where the owner will always be the owner of the sole establishment, and the operator would just operate through a certain power of attorney. So one option is, and this is something we do know a lot of educational institutions are considering, is the conversion from a sole establishment to a limited liability company. But it has its own challenges, particularly when dealing with banks. A conversion from a sole establishment to a limited liability company does not automatically transfer the debt that the sole establishment may have incurred. So it's very important at that stage to be very transparent with the lenders that the debt would need to be transferred through the conversion process. So the limited liability, when it's converted and has the necessary corporate governance, would also undertake the necessary debt there availed. The two minor points I just like to highlight on what Gemma had mentioned earlier on the shareholder injection. It's very important to understand that, yes, whilst in the past the shareholders have derived significant amount of dividends, and this is probably the right time for that injection to come through. When dealing with banks, under the stimulus packages being provided to the banks, there is also a restriction on distribution on bank dividends. So when the bank dividends are restricted, it's fair play that the shareholders of the borrowers need to also make some more sacrifices. The last part on Ajay's point, in terms of private equity institutions coming in, if they are coming in through debt, and as we've seen that the mezzanine debt market is catching up with the bank debt market prior to the COVID-19, that's where they would need also some security over the assets which are probably already secured to banks. There is a concept of second ranking security which has never been explored before in terms of some of the more secondary asset security. So that's something that can be looked at, that if there's enough value in the assets which can secure the primary lender as well as the mezzanine lender, which comes as a private equity.
Thanks, Mahmood. Looking to the sort of other, so we focus on the supply side and finance available to educational institutions. I'd like to sort of briefly look at the demand side and what financing options are available for parents and students. And AJ, if I can ask you for your comments on that. I know it's an area that you've looked at in the past.
Hey, I think I got most of that, Ivor. You faded out at the very end.
Sorry.
Not a lot of financing options available in at least the UAE and the wider GCC region. And we did, EY Parthenon did a study a few years back. A lot of those findings are still very relevant. It was more developing market focused, but a lot of those findings are still very relevant to the GCC and the broader MENA region. We did some check. I got somebody to do a little bit of a check for me through secondary, and I think that only 3 out of the top 10 scaled higher education providers have loan options available on their website right now for students. And it's an important one to cover, right? Higher education especially is a big tool for social mobility. You can right now, especially given these times, higher education institutions and operators can expand their market. They can go after the middle income parents and students as well. Across the GCC, across South Asia, which are the two big source markets for the Middle East hubs. And what happens there is these for financial institutions to take the first step is harder because these are micro loans. They have a high administration cost, but the advantage there is that you can probably get a customer for life. You can, once you sort of catch them young and they stick through the banking system, probably holding an account, buying more loan products, buying other products, and staying with the bank for a long period of time. But I think the first step will have to be taken up to sort of increase the depth of the market by higher education institutions themselves. Maybe, and again, there's going to be something that we spoke about earlier, the flight to quality, both from the demand side and the supply side. In such times, improved sort of graduation rates, placement rates, data around that, the prospects of a graduate once they complete their studies and go into the marketplace, into the job market, what salary they get. That sort of data is going to become really important, and institutions which have been capturing that, doing a lot on that through their career services cell, allowing, opening it up to financial institutions for them to take a more informed call about the prospects of a student who joins their institution is going to become really important. But I think the higher education institutes are probably going to have to take the first step there, maybe setting up easier tools for students to evaluate on the website itself whether they're eligible for loans or not. They are essentially the first point of contact for students. A lot of students don't even know if they have the option of loans and such products available. But I think that's where it's going to come down to providing that making that case to higher education, making that case to financial institutions that some of those models need to change, and maybe instead of just looking at credit history, you look at the prospects of a student at a certain higher education institution becomes more important, and that's probably the change that needs to happen for the depth of the market to increase and more options to become available to higher education providers. It has a lot of benefits for higher education providers. Usually students who take up financial help or loans take up higher priced courses, so that improves your per student margin or course margin. It allows you to utilize some of your unutilized capacity, increase that. These students are more motivated in general to complete their education, stick it out throughout the duration of the course. They're more likely to push that extra bit harder, apply to higher paying jobs, and sort of build that alumni network as well going forward. So I think there are a lot of sort of advantages, and it's a win-win for both higher education institutions and for financial institutions if the market gains some depth.
Thanks, AJ. And over to Gemma from the bank's perspective on that. It'd be interesting to hear.
Yeah, thank you. And yeah, I completely agree with you, AJ. There's, across the GCC and the UAE particularly, there's very little provision historically to support both the parent and also the students themselves in higher ed in particular. So we've actually started to sectorize the retail banking proposition as well as corporate banking, and we've spent a lot of time developing that proposition. So thus far, we've got a very strong proposition in terms of the teacher. So for example, any expat teacher that's coming from any of the 60 countries we are on the ground in will open their account before they arrive. We meet them at the airport. We give them a local SIM card. We smooth that process, and we've recognised that we can absolutely do that for international students, for example, and we're just about to launch what that means into the market in the next sort of 2 weeks or so. But also, and importantly, since COVID, we've looked at how we can support the parent during this. So again, we're almost there to launch a parental student loan. So this will allow the parent to draw down in tranches for the payment of their school fees over the year. And we actually work with the school institutions and actually give preferential treatment based on the relationship we've got with the corporate business, which I think is what sort of really makes the difference here, particularly in terms of risk management. And also we're looking at a student loan. So where the student, if it's a postgrad student, perhaps got a part-time job in the region and doing their studies, looking to lend directly to them. So I think that will make quite a bit of difference. But in particular, the parent loan, because cash flow is becoming more of a challenge, particularly perhaps where one of two working parents has lost their job and so on and so forth. So watch this space, and I'll make sure I share the material with you, Ivor, to share with the audience of this call once it's launched.
Thank you, Gemma. I would like to come to some questions, and I'll ask the panelists maybe if you could keep the answers to one minute because I'm conscious of the time. I know that's difficult for all of us to drop that little, but let's try. Mamoon, maybe this one for you. Why aren't REITs stepping in to acquire building assets? Is there room for an education REIT?
There definitely is, but at the moment, I think REITs are largely driven from income generation from the asset itself. They've been the REIT regulations are very recent, there is an element of capital markets here, so the Securities Commodities Authority would need to approve them. At the moment, we're at a stage in terms of the maturity of the market that REITs are more focused on areas where there is a rental yield coming out of real estate assets, as opposed to an income generating asset from a commercial enterprise. That's probably one of the reasons.
Yeah, thanks.
Yeah, sorry, I was just going to add on to that, because I've looked at a number of sort of sale and leaseback transactions historically prior to COVID, and you know, the yields that some of these REITs have to return can be significant, and therefore they've struggled to make it work in terms of what the school is able to pay versus what the REIT needs to return.
You describe it as impatient capital.
Yeah.
AJ, one for you, I think. What opportunities are there for operator consolidations? Isn't it time to build a platform aggregating smaller operators? I don't know, do they mean a tech platform or just, I think they mean a general platform. But I mean, there was news just yesterday about 2 schools in Sharjah, for example, sharing a campus for the next academic year at least. Any thoughts on that one?
Absolutely, I think it's a resounding yes to both. I think there is potential to build a platform. This is something I mentioned earlier as well. There aren't a lot of scaled K-12 assets, not just globally, but specifically in the GCC as well and in the MENA region, barring a few. And there is an opportunity for investors to come in and pick up assets and try and string them together across countries. That sort of gives them that diversity, makes them a bit more resilient. There is that upside on the platform multiple as well, which they can try and garner when they decide to sell the asset. And I think there is an opportunity for consolidation and building a platform for sure. You will, in our opinion, at least over the last few years, schools which have opened, which haven't ramped up well, there could be a potential for mergers happening within the region as well. I think it's more K-12 and higher education. There aren't a lot of back-end synergies that are available, but at least with K-12, the location becomes really important. It's a catchment-driven business. So schools which are close by, maybe both haven't ramped up well, one hasn't ramped up well, one has ramped up well. There could be potentials of sort of combining those and saving on rent and some other facilities, maybe optimizing some of the staff and back-end operations as well. And some of those will come up. I think the bigger driver though probably is going to be regulatory. I think any merger will require approval from the local regulators across markets, and I think that becomes important. In higher ed, again, we do expect, especially operators which haven't scaled up well, to try and think about sort of merging and trying and using some of those synergies. But I think it's really important to remember that if your sole aim is just cost cutting, then that's probably not the best reason to go in for a merger. You have to have some sort of an alignment on your strategic goals, the kind of disciplines you offer, what your sort of medium term, long term sort of goals are, whether you're a research focused institute or a teaching focused institute, and some of those aspects need to be aligned before you decide to go in for a consolidation or a merger.
Thanks, AJ. Gemma, I'm going to paraphrase this question, but it's kind of similar to what we touched on earlier. With blended and online delivery of education, why don't schools reduce the real estate footprint, presumably sell some of the real estate to access finance or use it as security? Look, I don't think it's as simple as that, but it's certainly, as AJ touched on, there are regulatory issues as well. But any comments on that one about reducing the real estate footprint in order to trim your sales?
Yeah, I think this is true across a lot of sectors, isn't it? Actually, when you think about retail provision and the fact that there will be a downscaling there without question. When you think about the way that we're going to be working, you know, HSBC alone will be looking at their whole property portfolio globally now and thinking, we've had 180,000 of our 240,000 staff working from home. Do we need this much real estate? And therefore, I think educators are looking at it in exactly the same way. And if there is more blended learning going forward and more flexibility about days in school and days out of school, I think unquestionably you have to ask the question about what happens to that real estate. But if I'm honest with you, with some of the conversations we've been having about the future of learning, with some really I was going to say long in the tooth educators there, but you know, really experienced educators that we've been on calls with, who actually say when we return to some form of normality, there will be a change, but it won't be as massive as potentially we're thinking. So, I mean, I think it's just going to be a watch this space, but I do definitely think that all businesses across all sectors are looking at their real estate and thinking, do they need as much of it? But then, of course, then the impact on the investors and the value of real estate is then the next question.
Yeah, thanks, Gemma. And the final question comes from somebody who's got up at 4 a.m. this morning, as he does every Tuesday morning, to join our EdWeb series. George DeBakey. Hello, George. Hope you had your first cup of coffee. AJ, his question is I think for you. Are planned school construction projects being delayed? In your experience, are you hearing of any projects that are now mothballed that were otherwise going to go ahead?
There is, you know, I don't think decisions have been taken yet, but there are conversations which are happening within a lot of firms. A lot of providers and investors are thinking about capital expenditure, you know, in a more sort of astute manner. There is they have to sort of they are thinking of delaying plans, if not completely mothballing them, or you know, completely sort of shutting them off. I think there is a shift towards thinking about more of the here and now and what's going to help them differentiate in this post-COVID world. So instead of say a school building or a school or a higher education institute coming up, there are operators and providers who are thinking more about, as I mentioned earlier, the tech infrastructure and thinking about diverting some of that capital expenditure towards that. There is also a thought, you know, capital expenditure. There is also a thought that if they can convert some of that capital expenditure to more operating expenditure or more variable costs by outsourcing a few things, that's again something which is a pointer that a lot of providers and operators and investors are thinking about and having a hard thought about. But I don't think it's too early for a lot of these providers to just completely decide that they're not going to do any capital you know, expenditure or investment going forward. I think once the September numbers come in, once the enrollment, and probably not just September, but maybe till the end of the year, because they're probably going to be a rolling effect, at least till the end of the year. But September is probably the first port of call, in a sense, where operators are going to see what the numbers are and then have to take a call on deciding on their capex going forward.
Super, thank you. Look, folks, we've reached our time. We could talk for another hour on this topic. I want to thank all our panelists for the fantastic insight today, and also the really practical information. And I'd like to thank our webinar attendees for joining us. And without further ado, I shall say good day and keep safe. Thank you.
Thank you.
Thank you. Have a great day. Bye.
Bye.